you see are building blocks to a $600,000 to $650,000 price, and perhaps $1 to $1.5 million price by 2030. We think most people in the world, at the very least, should have some of their assets in Bitcoin as an insurance policy against confiscation of wealth.
Cathie Wood's ARK Invest has filed a second amended application for a spot Bitcoin spot exchange traded fund ETF. The latest version, filed on October 11, introduces additional risk warnings associated with the Bitcoin network that could negatively affect the price of an ETF, among other minor adjustments. These new risks include issues related to electricity consumption, a community-driven upgrade to Bitcoin's source code, and competition within the industry. Furthermore, it stipulates that the custodian, in this case Coinbase, will hold the assets backing the ETF in segregated addresses on the Bitcoin blockchain and will not be commingled with corporate or other customer assets. Sam Bankman-Fried, co-founder of the collapsed FTX exchange, is currently on trial facing charges related to commingling user funds. Cathie Wood has also made very bold predictions regarding the bull and bear case for Bitcoin, and she gives her reasons in the video below. Let's now get into it and hear from Cathie. Don't forget to like, subscribe, and drop your comments.
The institutional allocation to Bitcoin in the base case, I know at one point we said 2.5%. That may have gone down a little, but if we're right, that assumption alone, I have been in the markets for a long time, and as new asset classes evolve, what institutions do in particular is they tiptoe in. They start with 1%, and then they migrate to 2, and then they migrate to 5. So I think in this one it's 2.5% for the base case. When there's a new asset class, it tends to end up in the 5 to 6% range. This happened to real estate. It happened to private equity, venture capital, which is now much more than 6% in many institutional funds. It happened to the whole category of emerging markets. And so I think it's that one alone is very conservative. And if you look at another one, the corporate balance sheets, Tesla, Square have Bitcoin on the balance sheets, but we make very cautious assumptions, and I think the corporate treasury assumption is 2.5% of all cash and cash equivalents in Bitcoin, and the bull case is 5%. If we're right and the purchasing power of Bitcoin becomes so obvious in the years ahead, meaning the purchasing power goes up instead of cash, dollars, staying pretty flat, if not in real terms deteriorating, then more and more corporate treasuries are going to be putting Bitcoin on their balance sheets. And in fact, they'll be the analysts will start questioning them. Why do you have 95% of your cash in a depreciating asset when you could put it into a cash equivalent like Bitcoin and have an appreciating asset? So remittances is another very big market. We assume 10% of remittances in the base case and 25%, instantaneous, no fees or minimal fees compared to 8% fees as migrants send back to their home countries. Mm-hmm. Sovereign treasuries, 1%, only 1% in the base case, 5% in the bull. Just like corporate treasuries, they'll be under pressure to start increasing their exposure to Bitcoin. And emerging markets, not just the state treasuries, but all of the populations who are subject to these swings in their currencies, and absolute demolition of their wealth when they go through hyperinflations. We assume 3% of the populations in the emerging markets, 3% of their assets in the base case go to Bitcoin and 10% in the bull. So those are some of the cases. And then there's the other utility economic settlement network case, and that's 5% of all settlements in the base case and 10% in the bull case. So that gives you a sense of how we have built those two estimates, and those are pretty conservative assumptions, we would suggest.
ARK Invest resubmitted its application in April this year, following a rejection in 2021. This was just 2 months ahead of heavyweight BlackRock filing its application. In July, Cathie Wood's firm amended the application to align it with BlackRock's, addressing the Commission's market manipulation concerns and adding a surveillance sharing agreement. The latest amendment only includes minor edits and details, said Alastair Milne, a prominent Bitcoin investor and co-founder and CIO at Altana Digital Currency Fund. Let us now hear what Cathie Wood has to say about this.
So now with the ETF, what is going on? I think, we know the research people at the SEC, and they know what they're talking about. They are really good. We've met the head of FinHub now, who reports directly to Chairman Gensler. And for me, the disconnect is they know so much, and they are so good that I believe this was much more Gary Gensler standing in the way. I don't know for sure because they could never say something like that. I just know from how we have discussed Bitcoin with them that they really understand it and they understand its merits. Most important. So this is Gary Gensler. Why he allowed, and I will say he because I think he's the gating factor here, why he allowed a Bitcoin futures ETF, which involves counterparty risk, and not a Bitcoin ETF, which does not involve counterparty risk. In fact, it is backed, ours would be backed by Bitcoin 1-for-1 in cold storage at Coinbase. That's why Grayscale has won its case. It is that argument, and so I think Gary Gensler's personal Vietnam is coming around to haunt him. I do think the SEC is moving now. He has, in effect, said, "Hey, I'm not the only decision maker. There are 5 commissioners here." That means some of the research that we believe is percolating up to those commissioners might be getting through to them and might be the grounds now for the approval of a Bitcoin ETF. And we don't think that the SEC will approve just one. They will probably approve a group of them. And that means it will become a marketing battle. And we do hope that our research, how much we give away our research, mostly because we feel it very important to educate. It's one of our mission and values. We hope that helps us as we, hopefully being one of those approved, go out and start marketing.
Some of you may probably be wondering what this talks about ETFs, what are they, and how they affect the financial system. Hang on, let's explain the concept. Exchange-traded funds, commonly known as ETFs, represent a significant evolution in the world of investment funds, offering a blend of characteristics from both stocks and mutual funds. At their core, ETFs are designed to provide investors with diversification, a principle rooted in the idea of not putting all one's eggs in a single basket. By holding a collection of assets, such as stocks, bonds, or commodities, ETFs enable investors to spread their risk across multiple instruments. One of the distinct advantages of ETFs over traditional mutual funds is their tradability. While mutual funds determine their net asset value at the end of the trading day and can only be bought or sold at that price, ETFs can be traded throughout the trading day, just like individual stocks. This gives investors the flexibility to react to market movements in real time. In the realm of expenses, ETFs typically shine with their cost efficiency. They often boast lower expense ratios compared to many mutual funds, making them an attractive option for cost-conscious investors. This lower cost is partly due to their passive management style, as many ETFs simply aim to track a specific index rather than actively trying to outperform it. Transparency is another hallmark of ETFs. They usually disclose their holdings daily, which stands in contrast to most mutual funds that might only disclose their holdings quarterly. This daily transparency ensures that investors have a clear view of what assets their ETF holds, allowing for informed decision-making. From a flexibility standpoint, the features of ETFs are notable. Not only can they be bought and sold throughout the trading day, but they also offer other trading flexibilities. Investors can purchase ETF shares on margin or even short sell them, providing avenues for both bullish and bearish market strategies. Furthermore, the structure of ETFs often results in tax efficiencies. When investors redeem shares of a mutual fund, the fund might need to sell securities, which can generate capital gains. However, the unique creation and redemption process of ETFs typically avoids this, potentially leading to fewer capital gains distributions. Lastly, the sheer variety of ETFs available in the market today is astounding. Whether one is looking to invest in a broad market index, a specific sector, commodities, currencies, or even thematic ideas, there's likely an ETF that caters to that interest. In conclusion, while the benefits of ETFs are manifold, investors must understand that they, like all investments, come with inherent risks. Diversification, traceability, and cost efficiency might make them attractive, but it's essential to research and comprehend the specifics of any ETF before diving into an investment. What do you think of the likelihood of getting a Bitcoin ETF this year? Share your thoughts in the comment section below. Don't forget to hit the like button, subscribe, and turn on notifications.